My name is Jennifer Rakovan. I'm a fourth-year undergraduate student at the University of Toronto pursuing a Bachelor of Commerce. Through both research and work experience in the Canadian banking sector, one problem stood out to me. In 2024, 28% of Canadians were considered low income, and of those, 61% report zero or negative household savings, which can lead them into defaulting to high-interest loans. Low-income Canadians are more likely to face barriers that prevent them from accessing traditional fair sources of credit. Low-income individuals can struggle with non-existent or poor credit history and inconsistent employment or income, which complicates their applications for bank loans and other personal credit products. On top of that, banks often require minimum balances, and their financial advice is not targeted enough to suit the specific needs of low-income individuals. These structural barriers, alongside biases like loss aversion, present bias, and the attention-action gap, can lead them into defaulting to high-interest loans, with interest rates reaching up to 35%, sinking them deeper into debt. To address this issue, I argue that a new alternative, low-cost source of credit should be introduced. These loans will have interest rates between 0 and 9% and require borrowers to have frequent check-ins with credit counselors and develop a goals-based savings plan to repay debt in under 24 months. This is modeled after a successful no-interest loan program in Australia, which is led by a microfinance nonprofit, the Australian government, and the National Australia Bank. This solution combines financial incentives, commitment devices, simplicity, and nudges to empower low-income individuals to seek low-cost credit, reduce household debt while increasing savings, and increase their financial education, which leads to financial resilience. Let's make change that counts.
Hello, my name is Naba Yunus and I graduated with my MBA from the Rockland School of Management at the University of Toronto. In Canada, the holidays are a time of generosity, family, and connection. But every January, millions of Canadians open their credit card statements and feel a wave of financial stress, not because they're careless, but because our financial systems make it easy to build debt and hard to pay it off. That gap between intention and outcome is what inspired my work. I've always seen myself as purpose-driven, and to me, financial well-being is about more than money. It's about confidence, dignity, and peace of mind. Studying behavioral economics changed how I understand financial decisions. It showed me that people want to do the right thing, but system design often gets in the way. And I thought, what if we redesign financial tools to work with human behavior instead of against it? That question led to this paper, which tackles a very Canadian problem, post-holiday credit card debt. Every year, people plan to pay it off quickly, but habits like focusing on the present, sticking to the minimum payment, or avoiding bills often cause delays. To me, that's not a budgeting issue, it's a design issue. So I created a practical solution using digital nudges built into credit card statements during the January billing cycle, when the motivation is highest. These include a suggested payment default, an interest saving prompt, an optional pre-commitment plan, and a progress bar to show repayment momentum. They don't remove choice, they make the better choice easier and more motivating. This approach is grounded in behavioral science, aligns with Canada's National Financial Literacy Strategy, and supports real financial resilience. And for financial institutions, it's a low-cost and high-impact way to strengthen customer trust and improve repayment outcomes. When we design better systems, we create better outcomes. And when we combine purpose with behavioral insights, we can make financial well-being achievable for millions of Canadians. Let's make change that counts.